Okay, welcome everybody. Tonight's trading session is about a new strategy. It's a strategy that you can use basically on Web Analyzer, but also on all other platforms. I just really like to use TradingView, so I took the Web Analyzer and I draw the lines in here. What you can see here is that we have one example that I took, which is the Canadian-Japanese yen. And what we are looking for is a few other indicators, and I changed the colors a little bit. So it's very important that you make sure that you're going to get the same settings. So this strategy is using two indicators. One is the BollingerBands on a very high time level. So you see here my BollingerBands, and they are on time level 68, 65, 68, 70. It basically means it looks back to the last 68 time frame. So if you're on 15 minutes, 68 times 15 minutes. So I will just mute myself here. You're muted? Okay. This is very important because this is giving you a very long Bollinger Band. What I changed in the style is that I made the base line, I made orange, and I made it very thick as well. And you can enable the background again if you want. I just turned it off for a second. So this is basically the settings for Bollinger Band. So Bollinger Band 68, and change the baseline to a yellow color. So then the second one is that you add, and you can add indicators, and you add the Ichimoku. And the Ichimoku cloud, I will just show you for a second how it looks when you open it completely, but you don't need everything. So when you open Ichimoku cloud, you see like a lot of lines. You see a cloud of Ichimoku. You see also some span line here. And we don't need all of those lines. So because this becomes kind of a mess, it's not a mess if you trade with Ichimoku, but we just want the TK cross. So we just basically want the conversion line, and we want the baseline. So the lagging span and the lead lines you can take off, and you can take the background of the cloud off as well. I made the lines a little bit bigger by putting this to the right. You see in the background that the lines becoming like thicker. So you can make them very thick, and then you see the lines. So the input of the Ichimoku you can leave the same. It's just standard settings, default settings. So now we have set up our indicators. I'm going to shortly explain what those indicators do. So the indicators, basically the Ichimoku gives the trend. It's also a trend line. So this two, the blue line, if the blue line is up and the red line is down, there's an uptrend. And when there is a red line up and the blue line is under the red line, then there's a downtrend. So this is basically how those two lines of Ichimoku work. And the Bollinger Band basically gives us now a very big idea of what the market is doing. And what we are looking for is a Bollinger Band squeeze. And I'm going to try to show it to you. This is quite a good example. Let me use a strong color. Let's see. So what we want to see is basically we want to see a straight market. And what we really want to see is we want those Bollinger Bands to squeeze in so that they are really becoming very narrow. And when the Bollinger Bands become narrow, what we want to see is this up. Basically, that one goes up and this one goes down. So that's what you want to see on the Bollinger Bands. So you want to see a Bollinger Band expansion. Now, when you see a Bollinger Band expansion, and in this case, the easiest way to see that is on the top side, because here you have all your graphs, all your lines, but here it's just very clear. If I erase it, now you know where to look. You very clearly see it's starting to expand. And when it starts to expand after a Bollinger Band squeeze, it becomes very close to each other. So when you see this, this happening, and you see the Bollinger Bands expand at this moment, then there is a new big volume line coming up. So I will show you some history before, but this is like one quite recent. So when are we going to get in? We are going to get in a sell when the last candle, when there's a candle that's fully extended and ended out of the Bollinger Bands. So you see here, sorry, little announcement. You see here that the candle ended after the Bollinger Bands. So the moment where we get in is at the start of this candle. Let me check if I can do that. It's a very big one. Let me use a sweet candle. Here is where we are going to get started in. So we take a sell when the next candle starts to form and the first one closed outside of the Bollinger Band. And we are going to take a sell. Basically, one of the confirmations, sorry, I switched that one. One of the confirmations very important is that those TK crosses, that the lines are on top of each other or that they crossed. So here you see them crossing. The second one. So we are in here, the lines are on top of each other, new downtrend is getting created. And as long as the red line stays on top, you can basically stay in the trade. But here you see that it starts to really aggressively come together. So they come together here. So that's why you want to get out. So which is the trend that we are taking here? We are going from here. You can, of course, go out here when you see the green arrow. This is calculated around 30 pips. But you see here that the lines are still very separate from each other. So, and here they even expanded more. So you can just stay in. And this is 70 pips. And then it started to go up. And that's when you, here basically at this place, sorry, other side. Then it started to go up, and here at this red candle, green candle, you see that really everything starts to move up. So you can say, okay, I get out here. So what we really advise here is to use a trailing stop. And for people who don't know what a trailing stop, I'm going to explain that now. So I will use a red line because the entry point is here. So this is our entry line. And we are going to put the stop loss on the yellow midline. So this is our stop loss. And then we can put our take profit at 70 pips, 60, 70 pips. So that's like the basics. I will check if I can draw it here. So this is our stop loss. Then we need here our entry. Entry. And here we take our take profit, 60, 70 pips. So what are we going to do is we take 20% of our top take profit, and we are going to fill that in our trailing stop. So in this case, let's say if we take 60 pips, then 60 pips is 12 pips trailing stop. So you need to fill in your trailing stop in points. So it's 120 points. Now, what does this exactly do? Your stop loss is situated here at a little bit above the midline. So what it does is when you are 15 pips in profit, it will automatically move the stop loss to entry line, and it will basically start to follow your trade. So in this case, that would have meant that you go to 30 pips profit, you fall back a certain amount. Let me calculate that for you. So in this case, the stop loss was 16, 17 pips, okay? So 17 pips. Then we go down and we get into 30 pips, around 30 pips. But we fall back to +5. So that means that our stop loss was following us with a 12 pip distance. So from this level, -12 is where our stop loss is at that moment here. So at the moment that the graph starts to pull back at this level, 85,008, the trade actually closes itself. So you could have 30 if your take profit was 30, but in this case you have 30 minus 12 and you automatically get out of the trade. So if you're, in this case, it's a very big drawback of 21 pips. So basically you'll always be stopped out by a trailing stop, but you will stop out in profit. So it's a very good thing. If you have small setbacks, so that there are small pips coming back, like less than 12, you basically stay constantly in the trade, but your stop loss is moving with you when it goes the right side. And then you go all the way to take profit 60. And there you will stop out. So this is basically how it works. If you wouldn't if we wouldn't have this big coming back, then here we would go out 12 pips lower because it went down, 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 and then it goes up for 12 pips here, and then it basically stops you out at this level automatically. So that's how this works. This is a strategy that works on cryptocurrency and on Forex. And the cool thing on cryptocurrency is that you will see those squeezes a lot when there's a lot of inactivity in a certain coin. So talking about cryptocurrency, when you have a certain coin that is really inactive because it's a really popular Asian coin, meaning that during American time it's completely squeezed. There's not a lot of volume, there's not a lot of activity. You will see those BollingerBands squeeze like crazy, which means that your stop loss from your entry point is probably just 5-6 pips. But the take profit at the moment that the market wakes up and you see this BollingerBand expansion, and at that moment you take the trade, it can, at the waking up of the market, it can go like 2,000, 2,500 pips up. So this is the nice part. Pip counting in cryptocurrency is a little bit different, but it just goes a lot faster as there's a lot more volatility in the certain coin connected to the US dollar. So in Forex, I would advise take 60, 70 pips with this strategy. You can most of the time reach it. Very important tip, the trailing stop itself is only working when you're MetaTrader. You need to put the trailing stop on your MetaTrader desktop. It's not a function on the mobile phone, it's only on the desktop version. And when you have a trailing stop on the desktop version, your desktop laptop needs to be active. MetaTrader needs to run for this function. So MetaTrader is basically looking to the price and moving your stop loss all the time. If you close down your laptop, I made this mistake once. I know it, of course, but I just made the mistake. I closed my laptop, I went to sleep. Next morning, I saw that my trading stops didn't work, and they went back to the real stop loss because they just didn't hit 60 pips, and they went basically all the way back, as you see this trade coming back now as well. So this is a really good strategy. If you use trailing stop, keep your laptop open. If you use like the take profits without managing 40 to 60 is really good. If you want to keep a look at it, 60 to 70 with the trailing stop, definitely 60, 70 pips on Forex. So that's really nice. And if your take profit in crypto is 2,000 pips, then basically your stop loss, your trailing stop is also 400 pips. So then your trailing stop is like 400 pips behind you, and you can like take the whole ride up. So let me clear this up, and I will use I will try to find one more example. I didn't save the template, so this is a good exercise. I'm going to show you very fast how to change the settings. So I delete volume, I delete other things I don't need. I change the Bollinger Band to 68. I change the style of the basic color to orange, and I make it a big line. Then I'm adding, by clicking here on indicators, I'm adding the Ichimoku cloud. If you want to read more about this, go to Wikipedia. Ichimoku strategy. It's like a really interesting strategy. And you can read all about the clouds and the lagging spans and everything. But first, you just need the conversation line and the baseline. And I basically made the baseline nice, heavy red. So you have a good blue one and a good red one, and also make those lines a little bit bigger, so they are really nice for you. Okay. So here you have another example. This is a small one, but here you see also, I will draw some lines. Here we see consolidated market. Oh, I will draw it a little bit smaller. Consolidated market. You understand what I mean? And here you see very definitely a expansion on both sides. So again, you see it, if it's a sell, you see it very clearly on the top. And when do we get in? We get in when the bar closes, and you see here the red line was on top, and it stayed quite long on top, and it crosses there. Like, as I said, this is a small one, but I still wanted to show it to you because this is the idea. And you go down from here to this level, or you will wait till this moment or this moment because it goes up, but it's okay because you see the red line and the blue line are very far away from each other. So you wait and you wait again, and here you see that the blue line spiked up. This is probably news. This is quite a big one, but like here you should be out. This is a very small one, but still a very good explanation of a Bollinger Band squeeze. Let me just calculate it for you. On 15 minutes, this is just 20 pips. So this is a very small one. And if this is news, the news will correct itself. And you can, like, if you're still in those trades, like, it's okay. Because you can even wait till, like here you see a big downtrend still. So you can even stay in here, still have 25 pips, or after this news, just be happy to, at 30 pips, to just close your trade. So also have patience. Those Bollinger Band expansions means a lot of new volume, and they mostly do what we expect them to do, because at the moment of a Bollinger Band expansion, you see, or it's under the Bollinger Bands, which means a sell, or it's above the Bollinger Bands, which means a buy. This is the opposite of a scalping strategy where we are trying to take the other ones. But I'm going to find another example to make it a little bit more clear, maybe a little bit more in the past. Please, trading view, let me scroll. There we go. Look, here we have a nice one. Here also you see it's in the night, 3 o'clock UTC time till 6 o'clock. So you see a squeeze. And basically here you see the expansion. That's why I'm saying look at the opposite side. It's the easiest one. We get in when the first red candle closes. So it looks late, but just get in when the first red candle closes under the Bollinger Bands and take the whole ride down. When you see it goes up here a little bit, just get out. You can also get out here. As you see, this is probably around 30 pips and this is probably around 70 pips. It's all the time the same, people. It's really not that hard. Here you see 20, 25 pips, and here we got 60 pips. Take the 60 pips and get out. If you have trailing stop, you have trailing stop of 12 and you get out automatically. Again, your stop loss, let me draw your stop loss. Here's the midline, there's your stop loss, here's your entry point, and here 60 pips is your take profit. Use a trailing stop to get your stop loss moving automatically with you in the plus. So when your trade goes down a little bit, that you automatically get out and you have risk-free trades all the time. Basically, when you're plus 12 pips, your stop loss will move, and it's risk-free to take to take it down. So this is a very good example. And then later here we see again, here's again a straight line, and then we have the squeeze that we just discussed, which was a small one. So, but you see here, basically this happens all the time. I think it almost on Forex, it almost happens every day with every currency. I'm doing this on 15 minutes. You can do this on a 1 hour time frame as well. So 15 minutes and 1 hour are like the best two to do this strategy on. Here you see it, 1 hour. Just a very short calculation. You start here when the Bollinger Band starts to expand. First candle, and look this right, bam, 120 pips. How do you know that you can stay in? The red line stays on top, Ichimoku. Tiki cross comes here. Tiki cross takes so long. You definitely go out when the TK crosses. So let's say you stay in all the way till the TK cross. Bam, 114 pips, 4-day trade, but this is like just one big wave. And then it went up a little bit and then it goes down further even. But like this here at the TK cross, you definitely get out, 114 pips. So these are really nice long-term trades. To be honest, I was trading a lot with Ichimoku Cloud 4 or 5 years ago. I took a lot of pips with studying Ichimoku. It's a Japanese strategy. Check Wikipedia for the complete explanation, to also use like the clouds and the crosses and the other confirmation lines. But the combination with Bollinger Bands, all of you already use Bollinger Bands. So do Bollinger Bands and a simple version of Ichimoku, and this is really going to help you. And you see it happen all the time. I hope I can scroll a little bit. Let me just like pause it for a second. Let me see if I find another pair. I need to set it up again. Now, last time the setup for everybody. Bollinger Bands. Change the color. Orange baseline. Thick baseline. Nice to see. Change the setting to 68. You can save your default here. I now have the default for scalping, so I'm not going to do it, but you can do here save as default, and it saves you all the time. Don't have to set it up every time again. You can delete volume, go to indicators, press Ichimoku. This one, unfortunately, is not in one of the templates of Web Analyzer, so just go to tradingview.com, make a free account, and add your own configuration there. You see, very wild Ichimoku style. Standard input, only need conversation line, baseline, and put the baseline in a nice red sharp color. Thick lines, and there we are. So we are on USD cut now. Now this is a very nice one. Basically here you see that it's going to happen. It's one big consolidated area. So this one is going to expand. Where do you want to watch? You want to watch here. The moment it starts to expand on one of the two sides, you know that the new trend is coming. So this is really one to watch. Let me just go a little bit back in history. I probably can show you this line before. It doesn't really let me scroll at the moment. Yes, there it is. So here you saw it also. This is a little bit bumpy, right? But you see here, last example, they want to get us out of the office. You see here, very big consolidated area. Expansion of the Bollinger Bands, expansion of the Bollinger Bands. You see it here. You take the first up, you go into the trade, because you also see they crossed here. They here are a little bit doubting, they cross here again, so I'm also okay if you go in at this second level. And even that it goes down a little bit, just see how much pips you take. Like, of course, you take this little way down, 46 pips in this case. But remember, your stop loss is under the baseline, in this case 65 pips. So this is not going to hit your stop loss. And look where you can go, 200 pips up. And if you wait for the cross, here's your cross, 190 pips. So basically you stay here in because you cannot see the future yet. You see the lines are out of each other, or you just close it at 200 pips because you're super happy with 200 pips, or you stay in till you see a very good cross. Here's also a cross, but it was still very much up. So I wouldn't go out here because it's out of the Bollinger Bands. Here also still in the line of the Bollinger Bands. I probably, if I manually see that it really goes into the Bollinger Bands again, I will probably get out myself. Otherwise, just wait for the cross. Look at this, 191 pips at the moment of crossing. So yes, you have 65 pips risk. Put it at the baseline, not higher, not closer, really. If you think 65 pips stop loss is too much, trade this strategy on 15 minutes. On 1 hour, you can take 200 pips, but you also need to risk 65. So that's the combination. This is the new strategy. This is a strategy that you can use, and just for a small idea, we are going to teach on the scalping again, and this is where you go 5 pips down, 5 pips down, 5 pips down, 5 pips down. So this is all the times when you go 5 pips down, and this is like the 4 times that people. Why are people calling me during a webinar? What the fuck? Okay, so this is where we can scalp 5 times down, or where you take 200 pips up. So this is the difference between scalping and the long-term Ichimoku strategy. I want to thank everybody for watching, and if there are any questions, let me know in the chat, or let me know in the group chats or on WhatsApp chats. Thank you very much, everybody.